Ever feel like you're just drowning in information? You know, articles stacked up, reports to read, just piles of stuff.
Yeah, I feel that.
But what you really need are like those key insights, right? The
Yes,
things that can actually make a difference.
exactly. The stuff that can move the needle.
Right, exactly. And that's what we're focusing on today, just for you, the learner. We're diving deep into some excerpts from Stephen Bragg's Accounting Best Practices.
Oh, cool.
It's a pretty dense book, lots to unpack. So our mission here is to pull out the real gems, the actionable stuff that can help you operate more effectively and,
Yeah.
efficiently
hmm
without getting bogged down in all the details, all the minutia.
Right, the shortcuts.
Yeah, the shortcuts. And the interesting thing is, while this book focuses on accounting,
Yeah.
a lot of what Bragg talks about applies way beyond just numbers, you know. It's really about making any business or operation run smoother.
I think that's what's so useful about Bragg. He doesn't just stay in the accounting lane.
Yeah.
It's like he sees the bigger picture.
Absolutely. He really does cover a lot of ground, too, from the nitty-gritty of accounts payable, billing, all that stuff,
The nuts and bolts.
to the bigger picture of budgeting and kind of overarching best practices. We're even going to get into why sometimes, and this might sound a little counterintuitive, but why sometimes not sweating every tiny discrepancy can actually be the best approach.
Ooh, that's interesting. I like that.
Yeah, so let's jump right in. When Bragg talks about best practice, what's he really getting at? What's his core idea there?
Well, what I find fascinating is his definition. It's actually very practical.
Okay.
He sees a best practice as any improvement over how things are currently done, which is, much more accessible than some folks who might say, oh, a best practice has to be this world-class, cutting-edge thing only the top companies are doing.
Right, it's got to be revolutionary.
Exactly.
Yeah.
Bragg acknowledges that for most organizations, those top-tier solutions just aren't realistic.
Yeah.
Maybe their tech isn't there yet, or their budget, or even just their ability to handle that much change.
Right.
So the key takeaway is improvement doesn't always have to be this massive revolutionary thing.
Okay,
Even small, well-chosen changes can make a huge impact.
that's a good way to put it. So instead of aiming for the stars with some complex overhaul, Bragg's saying even incremental changes can qualify as best practices.
Exactly.
Can you give some specific examples of what he means by that?
Sure. Let's take accounts payable.
Okay.
He talks about switching to blanket purchase orders.
Oh, yeah.
Think about all the paperwork that eliminates. That's a big improvement right there.
That's huge, yeah.
Same with using signature stamps and those procurement cards.
Mhm.
It streamlines handling all those smaller transactions.
Right.
Then in reporting, he talks about implementing something called activity-based costing.
Okay.
This gives you a much clearer picture of where your costs are really coming from,
Uh-huh.
which leads to better decisions and simplifying commission calculations.
Oh, yeah. Commissions can be a nightmare.
Can drastically cut down on errors and disagreements. So these aren't just theoretical ideas. These are real practical steps that lead to actual efficiency gains.
So for you, the learner, the point is you don't need a massive budget or a team of consultants to get started.
You don't need to boil the ocean.
Right. So we get Bragg's definition of a best practice, but what about the environment in the company? What needs to be in place for these improvements to actually stick?
Oh, that's key. Bragg emphasizes that management has to be truly willing to embrace change.
Mm-hmm.
It can't just be lip service. There needs to be real openness to doing things differently and a good reason for it,
Right.
a clear, compelling reason to change. Without that buy-in from leadership,
Yeah.
even the best ideas are going to fizzle out.
He mentions a scenario I think a lot of us have seen where new management comes in and wants to make their mark.
Oh, yeah, that's a classic.
How does that play into adopting best practices?
Well, it's pretty common. New managers often look for ways to make improvements.
Sure.
It's a way to show what they can do to kind of leave their mark, as Bragg says.
Oh.
And this can definitely create an environment where new ideas get more attention.
They're more receptive.
Exactly. But we have to remember, change for the sake of change isn't always effective.
Right,
You
right.
still need that solid rationale
Mm-hmm.
and genuine commitment to improvement. It doesn't matter who's driving the change.
It has to be for the right reasons.
Exactly.
So let's say you have that supportive environment, that willingness to change. What are the practical steps a company needs to take to actually implement these best practices?
Well, Bragg emphasizes that careful planning is essential,
Of course, yeah.
but it's not just about creating a plan and calling it a day.
Sure.
There are several key stages to the implementation process that are just critical for success.
So what are those essential steps that can't be skipped?
Well, for most improvements, the very first step is to really study and flowchart the existing system.
Oh, interesting. Even if you're going to completely redesign it.
Even then, understanding your current processes
Yeah.
helps you spot any unique requirements or dependencies you might not have noticed otherwise.
Okay.
And those things have to be considered in the new implementation.
Makes sense.
Bragg points out that companies often have these ingrained ways of doing things,
Mm-hmm.
and you can't just ignore them, even during a major overhaul.
It's like you're building on what's already there.
Right. It's like, before you start a road trip,
Yeah.
you got to know where you're starting from.
Great analogy. So what comes after mapping out the current system?
Well, it's not over once the new system's up and running. Bragg's really big on the post-implementation review.
Oh, okay.
This lets you see if you're actually hitting those cost savings or efficiency gains you were hoping for.
Right.
It also lets you spot any unexpected problems that popped up,
Uh-huh.
the kind of things you want to avoid next time.
Learn from your mistakes.
Exactly. And crucially, it lets you fix any lingering issues from the current implementation.
Okay.
Because often it's those smaller, unresolved things that can really impact employee satisfaction.
Right. Makes them resistant to the new system.
Exactly.
So it's not enough to just launch the new system and walk away.
Nope. You got to make sure it's working as intended and that people are happy using it.
So to recap the key elements for a successful implementation, we're talking about a thorough review of the current system, a solid cost-benefit analysis, being smart about new technology, testing the system thoroughly, training people properly, and communicating consistently throughout the whole process.
You nailed it. Those are the big ones.
Now, what about when a company tries to take a best practice that's worked really well in one area and apply it somewhere else, like a new branch or a different department?
Yeah, that's interesting. Bragg points out that replicating those successful best practices can be surprisingly tough,
Oh, really?
especially when you're expanding quickly.
I guess it makes sense. It's not just plug and play.
Right. Often, employees in the new locations only get a surface-level understanding of how things are supposed to work.
Uh-huh.
And that's not always enough for them to implement it properly.
So even with a proven best practice, the context, the specific environment, the people involved in the new location, all of that can make a difference.
Exactly. What works in one spot might hit a wall somewhere else.
It might need to be adapted.
Right.
We've talked about the steps for successful implementation,
Mm-hmm.
but it's also important to know why these things sometimes fail.
Yeah.
What are some of the common pitfalls companies should watch out for?
Well, Bragg highlights several key reasons for failure.
Okay.
A big one is just lack of funding.
Not enough money.
Yeah, either they go way over budget or they just didn't secure enough resources from the start.
Makes sense.
His advice, always build in a cushion, a contingency, into your initial funding request.
Pad it a little bit.
Right, because unexpected costs always pop up.
Always. Another obvious one is poor planning.
Oh, that's huge. Bragg's really clear about that.
If you don't have a well-defined plan,
You're asking for trouble.
you're setting yourself up to fail.
Exactly. Without a plan, you can't accurately estimate costs, staffing needs, or timelines.
You're just guessing.
Right. And you also don't have a way to assess and manage risks.
So failing to plan is planning to fail.
Pretty much.
And for you, the learner, understanding these potential roadblocks can help you avoid them in your own work.
Absolutely. If you know what the common failure points are, you can be proactive.
Now, we can't talk about implementing change without thinking about the people involved. How do these best practices usually affect the employees who have to actually use them?
Well, Bragg acknowledges that in the short term, there's often a lot of discomfort.
People don't like change,
It's true. And it can even trigger anxiety for some employees.
especially if they see it as a threat to their job.
Yeah, any kind of change can raise concerns about job security.
Makes sense.
And also, let's be real, a lot of these best practices, especially in accounting, are aimed at reducing payroll expenses.
Doing more with less.
Right, or at least managing bigger workloads with the same number of people.
Right. So those employee concerns are valid.
They are. And they need to be addressed carefully.
You can't just ignore them.
Nope. Change management has to focus on communication
Mm-hmm.
and really addressing those concerns head on.
Because if you don't, people are going to resist the change.
Exactly.
Okay, let's get into some of the specific, more interesting best practices that Bragg highlights.
Okay.
Yeah.
One that really caught my eye was in accounts payable. It's pretty different from the usual way of doing things.
Oh, yeah.
He talks about paying suppliers based on when you receive the goods, not when you get their invoice.
Interesting.
So can you walk us through how that works?
So what's really radical about this is it basically bypasses the whole invoice matching thing.
The thing accounts payable usually does.
Exactly. Instead, the receiving department becomes the key player.
Okay.
When a shipment arrives, they check it against the purchase order. If it matches, the system automatically schedules payment to the supplier,
Wow.
sometimes even through a wire transfer.
So accounts payable is pretty much out of the loop for these
For
transactions.
the most part, yeah,
That's got to be a huge efficiency gain.
it is. But Bragg emphasizes that it's not as simple as just flipping a switch.
True.
You need a few key things in place. The most important is a computer terminal at the receiving dock.
Okay.
So the receiving staff can enter the purchase order number and the quantity they received.
Right.
The system then checks that against a database of open purchase orders.
Yeah.
If everything lines up, payment is scheduled. But here's the crucial part. If there's no purchase order in the system,
Yeah.
or no purchase order at all, the shipment is rejected right there at the dock.
No exceptions.
Nope. That kind of discipline is key to making this work.
It's got to be strict.
It does.
I bet that really cuts down on discrepancies and all that back and forth with suppliers about invoices.
Oh, absolutely. It really streamlines the whole payment cycle.
Another accounts payable best practice he talks about is reducing the number of approvals needed for invoices.
Oh, yeah, that's a good one.
We've all been stuck waiting for a manager's signature at some point.
Oh, tell me about it. That's a classic bottleneck.
So many systems require a manager to sign off on every invoice before it can be paid.
Yeah, even if there's already a purchase order.
It's like a double approval.
Totally redundant. And it often applies to small invoices, too, even without a purchase order.
Right.
So what happens? Invoices pile up on managers' desks.
Get lost in the shuffle.
Yep. Suppliers get frustrated, and you risk late payment penalties.
It's a mess. So what does Bragg suggest instead?
He talks about something called negative assurance.
Okay.
So instead of getting approval for every single invoice,
Yeah.
copies are sent to the people who would normally authorize them.
Okay.
And the invoice is paid automatically by the due date unless someone specifically says, don't pay this. So the focus shifts from approving everything to just flagging the potentially problematic ones.
Makes sense. Most invoices are probably fine.
Exactly. This lets the vast majority of payments go through smoothly and quickly.
It's like a default approval.
Yeah, that's a good way to put it.
I imagine technology plays a big role in making this negative assurance thing work.
It's essential. You got to digitize those invoices and route them electronically, and ideally integrate that with some kind of workflow software.
So you can automate reminders and escalations.
Exactly. Make sure nothing falls through the cracks and deadlines are met.
Let's talk about procurement cards, or P cards, that Bragg recommends.
Mm-hmm.
They seem really handy for employees, but also kind of ripe for misuse if you're not careful.
Yeah, it's a balance. P cards are basically company credit cards.
Right.
But the difference is the controls.
Uh-huh.
You can set spending limits per transaction, per billing cycle. You can restrict where they can be used.
Like certain types of stores or vendors.
Exactly. Based on those merchant category codes. You can also limit the number of transactions allowed. And you get detailed information about each purchase.
For better tracking?
Exactly. So you're giving employees more purchasing power, but still keeping a tight rein on things.
So it's not just handing out free money.
Nope. There's a framework there.
I've heard that American Express has expanded their corporate card to cover recurring expenses like phone bills and stuff.
Oh, yeah. It's a way to consolidate all those little payments.
Mm-hmm.
And you get really detailed data for auditing. Bragg also points out that companies can have agreements with employees about P-card use.
Like penalties for misuse.
Exactly, to encourage responsible spending.
But Bragg also mentions when P-cards aren't a good fit, right?
Right. He says to avoid using them for inventory purchases
Okay.
because those need to go through your materials planning system.
To keep your inventory levels accurate.
Exactly. And they're also not ideal for big capital expenditures.
Because those usually need a more rigorous approval process.
Right. And a P-card could easily sidestep that.
Moving on to filing. Bragg's a big proponent of digitizing documents. And it's not just about saving space, right?
It's way more than that.
I mean, yeah, you save on storage costs, but what else?
The real power is in the access it gives you. Think about it. Customer service reps can pull up any document in seconds,
Wow.
no matter how old it is. It's all right there on their computer.
That's got to make customers happy.
It does, and it
Yeah.
eliminates lost files, which is always a headache.
And you can have multiple people looking at the same document at the same time.
Exactly. Great for collaboration. Plus, you can route those digital files for approvals.
Streamlines everything.
It really does. So you're going from a cost center to a strategic asset.
That's a good way to put it. Now let's talk about automating expense reports. I think we all hate filling those out.
Yeah. And for companies, it's a big administrative burden.
So automating that's got to be a win-win.
It can be. But Bragg points out that the software can be a big investment.
How much are we talking?
It can range from tens of thousands of dollars to hundreds of thousands, depending on how complex it is.
Okay.
And everyone who's going to use it needs to have online access.
So computers or terminals for everyone.
Yeah. And maybe even modems for dial-up in some cases.
Wow. So you got to factor in those costs.
You do. But a well-designed system can make the whole expense reporting process so much smoother.
From submission to approval to reimbursement.
The whole 9 yards.
What about the decision to centralize or distribute accounts payable across different locations or business units?
That's a big one. Bragg makes a strong case against having multiple accounts payable departments.
Okay.
First, it costs more. You need supervisors in each location. Second, it confuses suppliers. They might send invoices to the wrong place.
Especially if your company has similar sounding subsidiaries.
Exactly. Third, you need to make sure everyone's trained the same way and follows the same audit procedures.
To keep things consistent.
Yep. And finally, you lose some control. Local managers might try to influence the payment process.
So centralizing avoids all those problems.
For the most part, yeah. It gives you more efficiency and control.
Makes sense.
Yeah.
What about outsourcing accounts payable completely?
Bragg says to think carefully about that one.
Okay.
A big factor is how much you interact with your suppliers, especially if you're using integrated software where data needs to flow smoothly back and forth.
Right.
In those cases, it might be better to give trusted suppliers remote access to your system.
So they can do some of the work.
Exactly. You could also outsource just the routine stuff.
The more mundane tasks.
Right. Or even have them cut checks for you.
But that would require strong approval processes.
Definitely. You don't want to lose control of your cash flow.
Bragg stresses that management should always have the final say on check runs.
Absolutely. Regardless of who's doing the actual work.
So outsourcing can save money, but you have to be careful.
You do.
Okay, let's shift gears to billing practices. Bragg's a big advocate for sending invoices right after a shipment goes out,
Oh, interesting.
especially for businesses with lots of small transactions.
Makes sense. Get the bill out there as fast as possible.
Exactly. What's the main reason for that?
Speed up cash flow. The sooner you bill, the sooner you get paid.
Makes sense. But I imagine there are some challenges.
There can be. Bragg mentions a few. Your accounting software might need some tweaks to group multiple shipments to the same customer on one invoice.
Okay.
And customers might be used to getting a separate invoice for each shipment.
So they might push back on a change.
They might. Plus, if some shipments happen early in the month and you don't bill until later, it could actually slow down your cash flow a bit.
Interesting.
So Bragg's advice is to analyze the interest costs on your working capital versus the potential savings from faster invoicing.
To see if it's actually worth it.
Exactly.
Another billing best practice he highlights is electronic data interchange, or EDI.
Yeah.
For those who aren't familiar with EDI, can you explain what it is and why it's so beneficial?
Sure. EDI is all about automating the exchange of business documents. In this case, invoices. It's like replacing the old paper-based process.
Printing invoices, stuffing envelopes, snail mail, all that.
Exactly. With EDI, your computer system automatically creates an electronic invoice in a standard format and sends it directly to the customer's system.
No more manual data entry.
Nope. The customer system automatically grabs the invoice and translates it into a format their accounting software can understand.
So it's faster and more accurate.
Way more accurate. You eliminate all that manual handling, which is where most errors happen.
Makes sense. Bragg also mentions automatically checking for errors during invoice data entry.
Oh, that's crucial. Catching those errors before they cause problems.
So what kind of checks are we talking about?
Well, you can validate zip codes, make sure they're in the right format. You can automatically fill in the city and state based on the zip code. You can validate prices against a master list.
Okay.
You can automatically fill in product descriptions based on part numbers. And you can flag any new part numbers being used for existing customers.
So the system's doing all the heavy lifting.
It is. But Bragg warns that setting up these checks can take a lot of programming.
Especially if you're not using custom software.
Right. And there's a chance that software updates could overwrite your custom changes.
So it's something to keep in mind when choosing an accounting system?
It is.
What about having shipping staff enter data directly into the accounting system?
Oh, that's a good way to streamline things.
Cut out the middleman.
Exactly. If shipping staff can input the details directly, you avoid delays and reduce the chance of errors.
Because they're the ones who know the information best.
Right. But you need to give them terminals and train them properly.
And what about
And
it?
do regular audits to make sure the data is accurate.
So it's about putting the responsibility where it makes the most sense.
Exactly.
Okay, let's talk about budgeting. Bragg says it's really important to figure out the maximum amount of funding you have early on.
Oh, yeah. Set that limit up front.
Why is that so critical?
Well, Bragg says a lot of budgeting processes get bogged down because management keeps revising the plan.
Trying to make everything fit.
Right. They have all these ambitious ideas, but the resources aren't there.
So they go back and forth, back and forth.
And the accounting department has to keep redoing the numbers.
What a waste of time.
It is. So the solution is to figure out how much money you actually have to work with right from the start.
How do you do that?
You look at your assets, what you could potentially borrow against.
Okay.
You see if public offerings or bond placements are feasible.
Though that's less likely for smaller companies.
Right. And you project your cash flow from operations.
So you know what you can realistically spend.
Exactly. That way, you avoid creating unrealistic budgets that everyone knows won't work.
It keeps everyone grounded. He also suggests creating a simplified budget model just for senior management.
Oh, that's a great idea.
What's the advantage of that?
It lets them run what-if scenarios without bugging the accounting department every time.
They can play around with the numbers themselves.
Exactly. But to make it work, you have to talk to them and find out what variables they care about most.
What are some examples?
Things like labor and materials costs, inflation, potential pay raises, changes in benefits, seasonal ups and downs in revenue, tax rates, interest rates.
So you can tailor the model to their needs.
Exactly. The goal is to make it concise and easy to use.
Not a massive spreadsheet.
Nope, ideally just a couple pages with the key line items.
And you can link it to the main budget data for automatic updates.
Or update it manually if you need to.
So it's a tool for high-level planning.
Exactly. It frees up the accounting team to focus on the details.
Let's touch on a few general best practices Bragg mentions. One that stands out is eliminating all transaction backlogs. Why is that so important for efficiency?
Bragg says backlogs are a sign of a bottleneck.
Something's not working right.
Exactly. If transactions are constantly piling up, it means the system can't handle the volume.
It's like a traffic jam.
Yeah, exactly. It causes delays and affects other processes.
So it's not just about catching up.
Nope. It's about fixing the underlying problem.
Finally, he recommends restricting the use of journal entries
Yeah, that might seem strange.
because they're such a basic part of accounting.
They are. But Bragg says overusing them can make your general ledger messy
Harder to understand.
and harder to audit. Because journal entries can sometimes be used to bypass normal procedures.
Which could hide errors or even fraud.
Right. So by limiting journal entries and using subledgers and automated processes instead.
You get cleaner data.
Exactly. Easier to manage and understand.
Well, we've covered a lot of ground today, really diving deep into Stephen Bragg's accounting best practices. It's amazing how even small changes can make a big difference in how efficiently a business operates.
It really is.
And for you, the learner, I hope this has given you some key takeaways without overwhelming you with all the details in the book.
That's the goal. You don't need to memorize every single thing.
Right. It's about understanding the core principles.
And knowing how to apply them.
So as you think about what we've discussed, consider your own work or your own organization. Where could a small change, even a subtle one, unlock some hidden efficiencies?
Yeah, think about that.
What if the key to better insights isn't more data, but better processes?
That's a great question.
And on that note, we'll wrap up this deep dive. Until next time, keep learning.
And keep thinking critically.
Axel.